Good morning, everyone. A very warm welcome to Think Tank 2023. My name's Andrew Hardy. I'm the Investment Director here in the UK for Momentum Global Investment Management. And it's a pleasure to see so many familiar faces again with us this year, as well as plenty of new ones, of course. For those who are newer to it, it is very much an international mix of delegates here, many from South Africa, Hong Kong, the rest of Asia, across Latin America, Mexico, Chile, etc. And a handful who've made the relatively shorter journey across the UK. But far or near, thank you very much for joining us here today. This is now our 22nd think tank, and we're proud to have built and maintained such a strong following and reputation for the conference over the years, as demonstrated by some of you having attended almost every event over the years. And I believe one person, Jacques, who claims to have made every single one. So well done, and thank you. The regular attendees amongst you will appreciate it's quite a change of venue for us this year. From having hosted Think Tank in some of the city's oldest and very impressive livery halls to what is now an ultra-modern venue and truly world-class location. We hope you enjoy the change and indeed the views as well. Once again, we have an exciting lineup of top-level speakers sourced globally from across the investment industry to provide you with, hopefully, unrivaled thinking on the issues you face when managing and advising your clients on investments. To begin with, I'd like to take a couple of minutes just to set the scene for the day and a half ahead and provide a short overview and update on our business. Momentum Global Investment Management was set up 25 years ago to run the international assets of our parent company, Momentum Metropolitan Holdings. As one of the largest insurance and investments businesses in South Africa, with 16,000 employees and assets of over $40 billion, our parent has always provided strong backing for our UK business. And with that support, MGIM has grown steadily over the years, whilst remaining focused as a specialist investment business with a boutique-like culture and entrepreneurial spirit, and very much a global mindset, both in terms of our client base and our investment universe. We specialize in offering multi-asset, outcomes-based investment solutions, global single asset class funds, and bespoke investment consulting services for retail and institutional investors in South Africa, the UK, and numerous global offshore and expat markets. And what we believe makes us different, our USP, is our partnership mindset and our unwavering focus on delivering an exceptional personalized service to you, our clients. Those partnerships are built on the foundations of world-class investment capabilities, our experience and knowledge of the markets we operate in, our frequent and open engagement and the access we offer, our high standards and can-do attitude, and critically, a unique focus on designing solutions that help your clients achieve their stated investment outcomes. We've now grown to have $8 billion of assets under management with 75 employees across our offices, mostly in London, but also in Windsor and Liverpool. The multi-asset and single asset class investment solutions that many of you are already familiar with are managed by a 22-person strong investment team, which I'd say, given the experience, continuity, and focus across the team, is incredibly well equipped to deliver on the outcomes we target across those portfolios. Our performance delivery over many years has been built around the core foundations of a long-term valuation-driven approach, deep proprietary research, and true portfolio diversification. And it's the consistency and conviction with which we implement this, along with our focus, that I think sets us apart from so many others and makes us a valuable partner to your business. Many of you will be able to attest to the continuity of our team and business over the years, which is, I think, should be so valuable to you as our clients. It means you can place store in our track record as being generated by largely the same people and process as you see in front of you, and thereby provides confidence around what you can expect going forward. But like any business, we're always evolving, and there have been a few bigger leaps in the past year that I'd like to highlight. After over 20 years with our group, the CEO of Momentum Metropolitan Holdings, Hilly Mayer, announced his retirement this year, with Jeanette Murray being appointed as his replacement. She first joined Momentum over 30 years ago and rejoined as CEO of our group investments division in 2018. Those who know her better will appreciate that she comes with an energy and drive that I've no doubt will sustain and accelerate the progress of our wider business for many years to come. Prior to this appointment, she was also the chair of our MGIM board in the UK, so she knows these parts of our groups intimately and prizes the strengths and opportunities that we and our client base offer as a leading driver of the group's growth ambitions beyond South Africa. And testament to the importance of the international growth opportunity, our MGIM CEO, Ferdy van Heerden, has recently been appointed as Jeanette's replacement, CEO of that group-wide investments division. Ferdy's led our business since 2010 in London and has worked in the financial services industry for over 30 years, so brings a wealth of experience to this new role. His CEO role will be based in London, where he'll spend around half his time, and so will remain very close to this business, as well as looking after a much broader portfolio in South Africa, which will enable him to share that experience and global mindset across the wider business. You'll hear from Ferdy tomorrow morning with more on our business and approach. Moving on, another key development for our business was the acquisition of Crown Agents Investment Management, or CAIM, which was completed in April. This represented a wonderful niche business with very experienced and like-minded people, and a different but highly complementary client base and skill set. While we're proud of our long heritage at MGIM, it's nothing compared to CAIM, which can trace its history back to 1749 and has provided financial services to their focus markets since 1833. CAIM brought an additional $3 billion of assets under management, mostly in bespoke fixed income mandates for official institutions internationally. That's primarily central banks, for whom they manage a portion of their foreign exchange reserves. The business is led by Robert Sgrava, CEO, who previously held senior roles at the World Bank in Washington, JP Morgan Asset Management, and the Central Bank of Latvia, who's supported by several other very experienced team members that are now integrated into our investment team and wider business, all based in our London office. As well as increasing and diversifying our asset base, acquiring CAIM bolsters our direct fixed income investment capabilities, something that we'll increasingly tap into within our multi-asset solutions and through new single asset class strategies going forward. Roberts and other members of the CAIM team have joined us here today, so I'd encourage you to say hi during one of the breaks. And beyond them, there are, of course, many more of my colleagues here with us who you can pick out with these red name tags from our UK and South African teams, as well as from Momentum Wealth International, our Guernsey-based investment platform. So plenty of people to talk to if you want to know more about any of these developments or other. Onto the event itself. While Think Tank will doubtless provide you with, hopefully, plenty of insight into our investment management business and team, our focus has always been on making it as valuable as possible for you delegates, by delivering serious and value-additive investment thinking, and by placing the emphasis on what lies ahead rather than what's been before. In this way, we hope you can use the content to shape discussions and strategy with your clients. This year, we bring you an agenda of 13 external speakers representing industry specialists from around the world, all of which we partner with in various capacities within our multi-asset solutions. And crucially, the speakers are the decision makers themselves, the founders, portfolio managers, and CEOs that are ultimately responsible for your client assets. We're extremely grateful for their valuable contributions to this event. Our theme this year is soft landing, hard landing, or no landing, strategies for a wide range of outcomes. When we discussed and ultimately settled upon this theme earlier in the year, we were, I'd say, quite worried that the answer may have become apparent by September. But instead, I'd say it actually seems much more uncertain than it was then, with a wide range of potential near-term outcomes for the global economy from here. This theme reflects the growing importance of developing flexible and agile investment strategies that can navigate the rapidly evolving market conditions around us. This time last year, the consensus view was that we were on the cusp of a sharp growth slowdown and potential recession, driven chiefly by high and rising inflation and the very hawkish policy response from central banks. There's been every reason to become more bearish over the past 12 months, starting soon after last year's event with the so-called mini-budget, or LDI crisis here in the UK, and associated political and market turmoil. Then the collapses of SVB and Signature Bank in the US, amongst others, in Q1 of this year, along with Credit Suisse in Switzerland, and of course the ongoing war in Ukraine, and the stalled post-lockdown recovery in China. Markets moved to reflect these concerns, particularly post the banking turmoil in March, when they rapidly began to price in interest rate cuts by the Federal Reserve during the remainder of this year, sending two-year Treasury yields falling from 5% to 3.8% in a matter of days. But winding forward, it now seems that this was a brief blip, and the all-important US economy has proved remarkably resilient, with rate expectations having adjusted higher again, and those same two-year yields back at 5%. But the questions stand as to what lies ahead. Various indicators point to a slowing growth environment, and the usual lags in monetary policy transmission mean that the effects of one of the sharpest phases of interest rate tightening in history are only now starting to feed through to the real economy. Despite all of this, global equity markets have risen 16% or so in dollar terms so far this year, on the face of it suggesting a benign market environment and assigning little risk to the hard landing or recessionary scenario. However, of course, these gains have been driven disproportionately by the so-called Magnificent Seven, which includes the likes of Nvidia, Apple, Amazon, and Meta, on the back of the AI-driven revolution spurred by the release of ChatGPT in November of last year. Those 7 stocks account for more than half of the gains of the US and global markets. Rarely before have equity market returns been so narrowly driven, which presents a very challenging backdrop for active managers. These themes and many more will permeate through all of the presentations, but with a diverse mix of speakers specializing in very different areas of the investment management industry, we expect no shortage of distinct views to be shared. There'll also be many more bottom-up, company, country, or industry-specific insights, which will highlight just how much room there is for nuance beneath the surface, and the value that can be derived from partnering with the world's leading specialist active managers, which we believe will prove ever more important in these more volatile times. Once again, we bring you an outstanding speaker lineup. I would say that, but I generally think it is. They include Kallum Pickering from Berenberg and Jeremy Slack from CIBC, both macro strategy specialists. Mark Baraboo, Sunil Thakur, and Dan O'Keefe from Jennison Associates, Sands Capital, and Artisan Partners, respectively, all visiting us especially from the US, but with highly contrasting growth or value-orientated approaches to investing in global equities. Sophia Lee from First Sentier Investors in Hong Kong, who will focus on opportunities in Japanese equities, a market that we've been for a while maintaining a large overweight in and which has quietly outperformed even the dominant US market this year. Lisa Lim and Adrian Petranu of Prusik Investment Management and Ashmore, respectively, will tackle some big questions on China specifically, the challenges and opportunities in implementing an ESG-driven approach there, and whether the slowdown there is the beginning of a slide into a Japanese-style environment of low growth and deflation. In the alternative space, Chris Tanner, representing JLEN, will outline how his near £1 billion listed investment company approaches contributing to the environmental impact challenges in developed markets through a focus on infrastructure assets. We'll also explore the latest advances in AI and investment-related application thereof through Wile Zhu and Tommaso Miglior, who both represent key strategic partners of our business in Robeco and M.M, respectively. My colleague Alex Harvey will outline our views on fixed income markets, where we see much improved prospects going forward and a key role to play in multi-asset portfolio construction, before handing over to Tatiana Grill-Castro of Musinish, who'll do a deeper dive on credit markets and where the best opportunities lie. And in a change of tack, our last speaker of today will be discussing regulatory trends in advice markets, in particular the new consumer duty legislation that's come into force in the UK this year, which is having a huge impact on the industry and which will undoubtedly inform new regulations in many offshore markets in due course. We have the wonderfully engaging Heather Hopkins from Next Wealth joining us to bring these regulation and compliance matters to life. And concluding the conference tomorrow, as ever, piecing all these expert viewpoints and insights together will be my colleague Glyn Owen, who requires no introduction to most of you. So a packed agenda, but all in bite-sized chunks of 30 minutes each. The sessions will be hosted by a variety of people from our team, and we're planning for there to be a few minutes of questions at the end of each session. So don't be shy about asking what's on your mind. And then just finally, just quickly in terms of housekeeping matters, in the hopefully extremely unlikely event of a fire, follow the green running man signs to the fire exits, where you'll gather on levels 31 and 32 to await evacuation lifts. Or I'm told you're welcome to use the emergency staircase in that event as well, but not sure about that option. I hope you'll all enjoy the conference, and once again, thank you very much for joining us. And sorry, one other housekeeping point actually, just on CPD points as well. To get those, please make sure that you check out at the desk in the foyer area with your pass in order to get those CPD points after the event. So now, without further ado, I'll hand over to our first speaker of the day. Kallum Pickering is a senior macroeconomic specialist at Berenberg Bank, who we work with in the UK for brokerage and research. He regularly features on the likes of Bloomberg TV and writes columns in The Telegraph and other media outlets, so some of you may be familiar with him already. Kallum will lay the foundations for the day ahead with a review of the global economic backdrop and key top-down drivers to consider, and share his outlook from here. Kallum, over to you. Thank you.
Okay, good morning, everyone. What a great pleasure it is to be kicking off this event. There's going to be lots of very market-specific stuff I imagine you're going to cover for the next couple of days, and so what I would like to do is give you an idea of what I think the framework should be. I'd say the four most dangerous words in economics are this time is different. In many respects, what we find is the actors change, the themes change, but the laws of economics and the fundamentals are much the same. We just have to step back far enough in order to see them in the right context. So the title of this presentation, and it's one I've been giving now for a few weeks, the rocky road back to more normal times. We had a this time is different once before. The first economist to come up with the idea of secular stagnation, theme we're all familiar with in the wake of the global financial crisis, was an American guy called Alvin Hansen. And he said in his 1938 presidential address that essentially all of the best gains in living standards and productivity had happened in the 100 years before, and the 20th century would be one of stagnation, frustrating economic growth. He essentially said that the Western world, the advanced world, was a sclerotic, arthritic economy, and its best days were behind it. In the end, what we realized, that period was one of adolescence, of growing pains, not arthritic, and all of the best gains were ahead. And that is essentially my pitch today, that I'm optimistic. I see good reason to be optimistic, and if we lean back far enough, actually the facts themselves are very different in terms of what they say about the world today versus just a few years ago. So we all remember the new normal: sluggish economic growth, low inflation, low interest rates, chronic pessimism, a feeling that even in 2018 we could have had another decade of slow economic growth without ever building those normal, ordinary economic excesses that would lead to a recession. That era is over. There's no Japanification, there's no secular stagnation, there's no lower for longer. In many respects, despite the fact that over the last 3 years we've had two highly unusual shocks, what we see is a world where the baseline looks much more normal. So let's remind everyone of the shocks. COVID-19, of course the pandemic, the lockdowns, and then the Russian invasion of Ukraine. But while these shocks were taking place, we had a number of shifts in the underlying economy. On the demand side, we had an end of balance sheet repair. Banks were sufficiently well capitalized by around 2017, were in a position to take on risk and extend liabilities. Household businesses, they'd also rebuilt their balance sheets. With Mr. Trump in the US, we had a change in the fiscal tune from austerity to expansion. That's continued in the US. It's now a feature of European economic policy. And then on the supply side, we have to contend with aging populations, rising frictions to global trade. And so when we abstract from these two acute shocks, the war and COVID, what we find is a world that is slowly but surely actually returning to something that looks much more normal. We think we're in a world of boom-bust economic cycles, persistent inflation risks, more normal interest rates, but within that, also more normal animal spirits. I sent out a note earlier this year titled "Miserable but Still Spending," and it was a description of the fact that around the world, consumer confidence had hit a record low. And ordinarily, that would be the signal that I would say as an economist, this is the recession signal to pay attention to. Never before had we, in the US, Europe, and the UK, reached such low levels of consumer confidence and not had a significant pullback in aggregate demand. Now, of course, we had a frustrating economic period. We had this shortage of gas in the world and high prices, but the willingness to spend was still there. We see households, workers pushing their advantage in wage negotiations. We have the return of wage growth. We see firms pushing their advantage in final markets, putting prices up, trying to defend margins. We have central banks raising interest rates, initially quite fearfully, but now with the confidence actually that the underlying economy is not as fragile, the financial system is not as fragile as we had feared. And the big lesson actually in all of this is central banks will be much less fearful in the future about raising interest rates. We've adjusted to much more normal levels, and while there's a risk that we do fall into recession over winter, so far there's no real threat that we have a systemic crisis unfolding of the like we had in 2008, 2009. The question is, why has this changed all of a sudden? In 2019, we sent out 2 reports titled The Return of Productivity and The Return of Inflation. We had anticipated, but by the end of this decade, these more normal trends would emerge. But COVID, by pure accident, the locking down of economies, the aggressive stimulus, it generated a situation where we had this almighty pent-up economic energy that was released all at once. And it sort of lifted us out of this post-Lehman funk. And so even though the fundamentals had changed actually long before the pandemic, it took this unusual one-off event to reset the economic framework. And so if you take one thing away today from my presentation, it's that we see no economic evidence now for secular stagnation. We see no economic evidence that the West is heading for some kind of Japanification. Even Japan doesn't look like it's heading for Japanification at the moment. Instead, what we see is much more normal business cycle dynamics, and that's a world in which we need to be prepared for higher amplitudes in business cycles, central banks making policy mistakes on both sides, and an upside skew to both inflation and interest rates. 2 ways in which this is already visible. The 40-year bull market in bonds is over. Now, markets are skittish at the moment. It's anyone's guess really where rates end up at the end of the year, but they won't be 0, and they won't be the end of next year either. And central banks don't ever intend them to be, which is why they're so confident with their balance sheet unwinds. We see in risk markets, this is a chart that most people will be familiar with. This is the aggregate central bank balance sheet of the majors and the Dow Jones Global Index. For a while, it looked as if only central bank liquidity was pushing up risk markets. And yet we've had this quantitative tightening, or as I prefer to call it, quantitative reversal, since central banks do not themselves intend to tighten at all with this. And yet markets are adding risk, at least in aggregate. And I know there are concentrations, but still, this represents more money being put to work. So QT is a headwind, but what we're learning, and everyone can see the inflection point there, that since October last year, when pessimism peaked, when confidence was at its low, we've had consistent upside surprises around the world to economic data, probably with the exception of China. And as a result, markets have reacted to these upside surprises by taking on risk. Great example today, UK house builders, UK banks, on the back of the inflation positive surprise. This is the world that looks much more normal. We take on risk even as central banks aggressively tighten because the economy surprises to the upside. A far cry from a decade ago. This is where my optimism really starts to manifest. Our major issue today, 2 major issues in fact, are supply related. The first is the aging of populations, which will lead to labor shortages. It already is. It will restrain our productive capacity. And it's the higher costs of global trade, whether that's US-China, Europe-China, Brexit, South Korea, Japan. Altogether, this frustrates gains in supply potential. But potentially, I would say, there is one offset, productivity. And this again speaks to this time is different argument. One theme after the global financial crisis was that productivity would remain weak, essentially as far as the eye can see. And this so-called productivity puzzle, if you look closely enough, was never really a puzzle. And what the chart shows us on the left-hand side is that for OECD economies, after about 2003, 2004, the rate of productivity growth actually starts to accelerate. The best-in-class companies, that's big tech, it's the best-in-class manufacturers, raise their productivity over the last 15, 20 years at a faster rate than any time during the 20th century. That's the frontier of potential which is being pushed out. The problem is that, as you can see, the 95% of firms, the so-called laggards, essentially stuck with primitive technologies. For whatever reason, they didn't raise their productivity. Now, from an economic perspective, I can say that the one thing that we're waiting for is diffusion of technologies. And technology diffusion comes through capital deepening. When does capital deepening occur? When there's a price signal that we don't have enough productive capacity relative to demand. That's what these prices today are telling us. When balance sheets are strong enough to take on the risk of investment, and when there are solutions available to actually raise productive potential. That's AI, it's advanced robotics, it's the various advances in energy and medicine. And so the pushback I often get is, well, we've known about these technologies for a long time, even as early as 2000 for many of them, but why haven't we seen it so far? We have to be a little bit patient. Diffusion can take some time. Again, another historical fact, just to add a little context. In 1880, Mr. Edison founded a company to manufacture electrical power stations, the Edison Illuminating Company. The chart on the right-hand side shows that by 1910, about 15% of US households had access to electric power. That's 30 years after Mr. Edison founded his company. By 1930, it's 70%, and only by 1950 do we have 100% of US households with electrification. 70 years in the making. And this is the economy that had the biggest boom on the back of electricity. So diffusion takes time and it requires catalysts. And so our premise is essentially that with supply constraints coming from goods, because the global economy is at risk of deglobalization, to slightly, I would say, tone down the risks around that. We mostly have stabilization in global trade at the moment rather than deglobalization. But the aging population is certainly an issue. What we have here are the ingredients for improving productivity. And so my bet would be over the next 10 years, we should start to see a material improvement. So that's my framework. More normal interest rates, more normal inflation, more normal productivity, more normal business cycles. And with that, actually a risk over winter that we run into a central bank driven recession. A few summary points just before I get into the country details. US, base case is now soft landing for us. Technical recession risk over winter, yes. But we had anticipated that the US would go into recession already and it hasn't. And so we've had to ask ourselves, well, why is this the case? And we think we have some good reasons which leave us optimistic that we avoid a recession altogether. We think the Fed is done. China has big structural issues around real estate, and to understand these problems we need to remember just how difficult it was for both Japan and the West when they suffered their real estate problems. Eurozone has an interest rate issue to deal with over winter. Gas is not the problem. Germany is probably already in recession, but Europe broadly should avoid recession. And in terms of the key risks, central banks and geopolitics. So now to some country forecasts. You see here on the right-hand side chart, our US cumulative growth forecast for this year and next has almost doubled since the start of the year. Consistently, the US has defied expectations that it may suffer a hard landing. Question is, why is this the case? I think there are probably fundamentally two reasons. The first one is that actually in many respects the US is an economy with early cycle characteristics. There are some serious excesses in commercial real estate, and medium and small sized banks are overexposed. But broadly speaking, we do not see evidence across the US economy there. We're at the late cycle stage, where when the Fed starts to raise interest rates, suddenly these excesses unravel. These unsustainable excesses, these little bubbles are burst. That's what happened in 2006, 7, and 8. The second point is that we don't see any real evidence that US policymakers are going to make the sorts of mistakes that they made in 2008, which could turn a normal recession into something serious. It was a policy error, huge policy error, to allow Lehman to fail without covering counterparty risk. The US would have had a nasty recession, but the global financial crisis was a consequence of policymakers making a mistake. There's no evidence today that they'll make the same mistakes as we saw last year with the backing of the two banks that failed, or the unwinding in a safe way. And so what you have in the US is this perception by markets, by businesses, by households, that the system's not fragile, and where it might fail, policymakers will provide a backstop. Fiscal policy is a huge factor in this story. The Infrastructure Act, the CHIPS Act, the slightly oddly named Inflation Reduction Act, provide a huge tailwind to US aggregate demand. And what you see, at least at home, is even though much of the saving, the excess saving that had been built up during the pandemic has been spent, actually what we have now is a nice consumer upswing in the US driven by healthy real income growth. I think there are three risks that we need to be concerned about with the US. The first is that, echoing what we saw from the rating agencies, eventually the bond markets say, we don't like your fiscal policy anymore, it's too inflationary. Even the might of the US will not be able to defy the bond market. So let's keep an eye out for bond vigilantes. That would be a nasty growth surprise were it to happen. The second is, well, good chunk of the US banking sector needs recapitalization. That may provide a mild credit headwind. And then finally, US election next year will be extremely noisy. That will be difficult for risk markets, at least in the months in the run-up. China. This matters, of course, for Europe a great deal. The central problem is real estate. From afar, it's very difficult to know exactly what's going on. I think there are two observations that we can make with a little bit of confidence. The first is residential real estate excesses, when they start to materialize and when they've been associated with huge capital misallocation, are a long-lived problem. It took Japan 20 years. It took the US, Europe 15 years. It leaves the economy prone to financial risks. Now, this is a command-controlled economy. It's very different from market-based systems we have in the West, and as a result, that risk of a financial crisis is, I would say, vanishingly low. But the absence of the market mechanism where you need it also prevents the cleansing, which helps fix these problems in the end. And so it's probably the case that the short-term risks are smaller than we had experienced or Japan experienced, but the time it takes to fix these problems may be even longer lived. It also has close to horrific demographics. It's also an economy which is not yet on a per capita basis rich as the US, Europe and Japan was. It also has geopolitical issues. And when we overlay all of this, it makes for a very uneasy economic framework. It's an economy which we think will struggle to get out of the 3 to 4% growth range, basically as far as the eye can see. It's not obvious how you could stimulate through this. For who would you build bridges for? For who would you build houses for if you went down the old route of public investment? And it would incur debt, which is something the authorities want to avoid. It's not easy to stimulate exports. Even if you could lower the currency, would the West gobble them up quite so eagerly? We learned that lowering interest rates, stimulating the credit channel, is very difficult when you have real estate overhang. Consumers are pessimistic. And so the outlook is difficult. I don't think that China will be the major driver of global trade in this next cycle. That will probably be the US and European consumer. For Europe, the story is, at least from afar, fairly stable since the invasion last year. No growth in real GDP, virtually no growth in real GDP. But the story is really split into two halves. During the first phase, so that was probably spring last year until early summer, the major issue was supply. Would we have enough gas? And so we had this real constraint from the supply side. By and large, those risks have disappeared. What we now need to be concerned about is whether or not the ECB has already done it with its rate hike cycle. I don't think it has, but the point is, until spring next year, what we have to worry about is demand. And so it looks as if real GDP is flat over this period, but the first half of this flatness is a supply problem. The second half is a demand side problem. The good news is it's much easier to cut interest rates than it is to try and produce a load of gas very, very quickly. So if we see that there's an obvious policy mistake in the pipeline, from these fairly normal levels of interest rates, there's some stimulus. You see the big issue for Europe earlier, global supply linked to COVID. That is now unwinding. And, well, the detail in this chart is actually not that important. It's just to say that we need some very extreme, weird developments next year and the year after for Europe to genuinely fall into gas shortages. Prices may be high over winter, but the idea that we won't have enough gas seems to be remote. Let me make a point about the UK. We've duly suffered as a result of the noisy politics, no question. But underlying that, actually, fundamentals look fairly good. The banks are extraordinarily well capitalized, household balance sheets are in good shape, but chiefly, businesses are in good shape. We have a good 25% of GDP in cash sitting on business balance sheets. That's almost double what it was 20 years ago. Debt is at 1990s levels. We have the strong price signal. We have the labor shortages. We have an improving political environment, less uncertainty. Probably we have a boring election next year. Can you imagine it? Especially compared to what we'll see in the US. And even though markets are still very nervous about the UK, relative prices still at a 30-year low versus global equities. But if we look closely, what we see is businesses are betting their pounds on the UK economy. We have a 35% increase in business investment since the middle of 2020. And there's no sign that this is slowing down despite all these uncertainties. And so the money on the ground is sending a very strong sign about the UK. I think this is important. In many ways, this is the key chart which loops back to the initial point around productivity and around the return to normal. Let me summarize now just with central banks. Inflation is falling nicely. Most of that is mechanistic at the moment because of the energy price base effect. We think we get two handles in the US, the UK, and the Eurozone next year. By 26-27, we probably edge towards 3% again. Inflation expectations now are fairly well behaved. We think that central banks are more or less done. At least the Fed and the ECB are. Maybe we get one more from the Bank of England tomorrow, but it's not obvious. And then probably by next year we see gradual rate cuts. It's hard to imagine a world where central banks provide a lot of help for markets in this inflationary environment. So nowhere do we expect rates to go below 3%. But by and large, removing the tight element of monetary policy when economic fundamentals are good is a sufficient condition for economic growth to improve. And so I make a constructive macro case overall. I think we need to worry about recession seriously over winter, but more likely than not, we're on track over the next 2 or 3 years after these very odd shocks fade to return to what will be much more familiar economic performance, behavior. And if we just peer closely enough into the data, amid all of this stagnation that we see underlying behavior look much more normal already. And for me, that is the key thing to emphasize.